Welcome to a special edition of Tax Tip Tuesday. I'm Curt Brand. Today we will take a look at the tax bill passed yesterday called the American Taxpayer Relief Act. You may have heard this referred to as the Fiscal Cliff Bill. Here's a breakdown of the key issues. Individual tax rates. All the prior individual marginal tax rates and brackets are retained. For single filers with taxable income of over $400,000 and married couples filing jointly with over $450,000, a new top rate of 39.6% is imposed. Phase out of itemized deductions and personal exemptions. The personal exemptions and itemized deductions phase out is reinstated at a higher threshold of $250,000 for single taxpayers and $300,000 for married taxpayers filing jointly. Capital gains and dividends. A 20% rate applies to capital gains and qualified dividends for individuals above the top income tax bracket threshold. The 15% rate is retained for taxpayers in the middle brackets. The 0 rate is retained for taxpayers in the 10% and 15% brackets. The alternative minimum tax. The exemption amount for the AMT on individuals is permanently indexed for inflation. For 2012, the exemption amounts are $78,750 for married taxpayers filing jointly and $50,600 for single filers. Estate and gift tax. The estate and gift tax exclusion amount is retained at $5 million indexed for inflation. It was $5.12 million in 2012, but the top tax rate increases from 35% to 40% effective January 1, 2013. Business tax extenders. The increased exemption amounts under Section 179 are extended through 2013. The availability of an additional 50% first-year bonus depreciation was also extended for 1 year by the Act. It now generally applies to property placed in service before January 1, 2014. The Act also extended through 2013 a number of temporary individual tax provisions, most of which expired at the end of 2011. They are the deduction for certain expenses of elementary and secondary school teachers, the exclusion from gross income of discharge of qualified principal residence indebtedness, that mortgage insurance premiums are treated as qualified residence interest, the deduction of state and local general sales taxes, above-the-line deduction for qualified tuition and related expenses, and tax-free distributions from individual retirement plans for charitable purposes. We will continue to analyze the new Tax Act and will provide more details in next week's regular edition of our Tax Tip Tuesday video blog. If you would like to discuss how these issues affect you and your tax situation, please email us or call us at the number on the screen.